Have you ever looked at a chart and seen a sudden empty space, a spot where the price seems to teleport, leaving a clean hole in the candles? That hole is called a gap, and it behaves in a strangely predictable way. Stocks are weirdly drawn back to fill that hole, and then, the moment they do, they often reverse. Today we learn why, using the exact behavior Micha shows on names like Netflix and Meta. First, what actually creates a gap? It happens when a stock closes at one price, and then, before the next session opens, something big arrives. An earnings report, breaking news, an analyst bombshell. So the next morning, the stock does not open where it closed. It leaps. It opens far higher or far lower, leaving a vertical band of prices where no shares actually changed hands. That untraded empty band, sitting right there on the chart, is the gap. Now here is the strange part that traders obsess over. Gaps tend to get filled. The price often drifts back, sooner or later, to trade through that empty band, as if the chart wants to color in the hole it skipped. We say the gap has filled when the price returns all the way to the level it leapt from. It is one of the most watched tendencies in all of charting. Why would that happen? Think about what the empty band really represents. It is unfinished business, a zone of prices that everyone skipped over in the panic or the excitement. Buyers who miss the move are sitting there thinking, if it ever comes back to that price, I will buy. So that old pre-gap level acts like a magnet, quietly pulling the price back toward it over the following days. And now the heart of this lesson. Why does the stock so often reverse at the exact moment the gap finishes filling? Because that fill level is where two crowds collide. The short-term traders who were betting on the fill have now got exactly what they wanted, so they take their profit and stop pushing. At the very same spot, the patient buyers who promised themselves they would buy at that old level finally step in with force. Selling pressure dries up, fresh buying arrives, and right there, the move runs out of fuel and turns around. So the filled gap becomes a high-probability turning point. In a stock that gapped down and then filled lower, that fill often marks the bottom of the dip, the spot where it bounces. The gap was the target, and once the target is hit, the reason for the move is gone. This is exactly the behavior Micha points out again and again on real charts. The price hunts the gap, fills it, and pivots. But you must respect the different kinds of gaps because not all of them fill, and this is where beginners get burned. A common gap, from minor day-to-day noise, fills quickly and reliably. But a breakaway gap, the kind blasted open by a huge earnings surprise on a Netflix or a Meta, is a different animal. That gap was created by genuine new information that permanently repriced the company. The stock is worth more or less now for real reasons. And gaps like those often do not fill for a very long time, sometimes for years, because the price never should go back. The market has simply decided the company is worth a new value, and there is no magnet pulling it home. So the trick is telling the two apart. A gap on noise wants to fill. A gap on real, fundamental news may have no intention of ever filling. So how do you actually use all this? You treat the edge of a gap as a key level to watch, a likely target, and a likely place for a reaction. If a stock is drifting back toward an old gap, you anticipate that the fill could spark a bounce or a reversal, and you watch how the price behaves right at that line. The gap edge becomes one more piece of support or resistance, often a very powerful one. And now the honest caveats, as always. First, the popular saying that all gaps must get filled is simply a myth. Plenty of gaps, especially the big news-driven ones, stay open indefinitely, and betting your money on a fill that never comes is a fast way to lose. Second, this is a tendency, a probability, never a guarantee. It describes crowd behavior. It does not predict the future. And third, the long-term index investor watching none of this, just buying every month, is completely unaffected by any gap on any chart. So look again at that strange, empty hole in the candles. You now know what it is: untraded prices skipped in a leap. You know its pull, the magnet drawing the price back to fill it. And you know the climax, why the stock so often reverses the instant the fill completes, as one crowd takes profit and another finally buys. Just remember which gaps fill and which ones never do. I'll see you in the next one, where we meet an indicator called the CCI. Until then, Keep it simple and mind the gap.